What the VIX is, well, let's just talk about, options. So options, we can use them. In fact, the hedge funds, the mutual funds, the pension funds, the way they typically use options is to hedge, right? Because you can buy protective puts or protective calls depending on whether you've gone long or you've gone short. And so you don't necessarily have to liquidate your position to cash in order to protect yourself. You could use one of these insurance policies, these options. And of course, options are also traded, right? And there's a supply and demand for them. So if all of a sudden these, big money folks start buying a lot of options, that makes their price go up. It's like if you start buying, if there's all of a sudden a run on hurricane insurance where you live, then when you go to get a hurricane insurance policy, it's going to be more expensive than it was when nobody was looking for it, right? There's supply and demand, and there is for these options as well. Well, we can mathematically, extract some of the variables or influences to an options price out of the option. And what we're left with is that demand or supply of the option based on, you know, whether people are wanting it or not wanting it. In other words, you can almost measure the demand for this insurance policy, and that's called implied volatility. So the higher the implied volatility, the more people are fearful and confused and, you know, uh, upset, they're uncertain. And if the implied volatility goes down, well, then people are more confident. They're not needing those insurance policies. They feel like things are going the way they're supposed to be going, and they don't need to insure themselves, right? They feel fat, dumb, and happy. And so the VIX is actually kind of a amalgamation. I don't know if that's the right word. It's a combination of all that fear and confidence measurements over the S&P 500 stocks, right? And so it gives us a good understanding of whether the markets are, fearful. The higher it goes, the more fearful it is. The lower it goes, the more confident we are. And here I'm going to show you guys because we have from the beginning of the VIX, which was around 1985, right? So what you can see here is the VIX very rarely goes lower than $12, right? And that's kind of a psychology experiment. What that means is we never as investors, or should I even dare to say human beings, we never get so confident. We always have a little bit of fear or doubt in our mind. That might be, leftover reptilian brain, like where's our next meal coming from or something like that. But we only get so confident. But now you'll notice these various spikes. This was the last time, by the way, there was a major fiscal change. This was 1987 during the end of the Reagan administration when they decided to rejigger the whole income tax, right? And that's very similar to what's happening now. It's not that we're rejiggering the income tax and what you can deduct and what you can't deduct. We're basically saying we might be switching from an income tax society to a tariff-based society. So that you're saying, but this was, this people went off the rails. There was something called Black Friday back in 1987. Then you kind of go forward. This was the first um, war in, the wall falling down, the first war in Iraq. And then you've got the dot-com boom and bust. You've got September 11th. You've got, the whole Afghanistan war. Then it got really calm for a while. Then we had the Great Recession, right? And then, there's been some times during that, whole time where fear kind of, and what this is showing is, we said we only get so confident, but when we get scared, out of our pants, we really do. We buy insurance. We we get scared and we take action, whereas we never get so cool that we ever drop all of our insurance policies. We always insure ourselves, right? It's kind of our risk averse nature. Here's COVID, right here, the beginning of COVID. And then, what's happening right now? We're starting to peak up again. Let me zoom back in because we can use some of these psychologies that we're talking about. Let me actually zoom out to about 6 months instead of 3 months. So, what our whole VIX trade is here is that we place 2 vertical spreads, right? One vertical spread is at the bottom. Here, I can show you here. Analyze. Okay. So we place one vertical spread at the bottom, and it's a credit spread, which means we actually get money from it, and when then we hope it expires worthless because then we get to keep that money that we got from it up front. So we do a vertical credit spread, and then with that money, we buy a vertical debit spread. And like I said, I always have this trade in place, right? Because the idea is we never get that confident. So we never actually believe that we'll fall off this left-hand side of the two vertical spreads because we always have a base level of insurance to our name. And then you've got this here. This is where we expect this trade to be all the time, right? This is that normal zone between like in this case, I have it between 16 and $20. Between 16 and $20, if the VIX stays in that range, well, then the trade's basically going to be, like you said, a break even trade. And at the end of its expiration, I'm going to come out with a little bit, nothing gained, nothing earned, but I had some protection. But remember, we talked about how the fear goes off the rails? Well, when the fear, and indubitably it does, when the fear goes off the rails, and a lot of the trades in our other portfolio, in the rest of our portfolio might come under some duress, this is when this trade shines, right? All of a sudden, this trade ends up on the top of this plateau and we wind up cashing out. So that's why we call this the ultimate VIX hedge. So you'll notice I got the credit spread, and in this case, I got the credit spread for 31 cents. Now, that's the amount money they give me, right? When I do the credit spread. Remember, when you do a credit spread, you don't get that 31 cents for free. Because if you were to fall off this cliff to the left-hand side, and there's always a possibility, even though we know people always keep a base level of their insurance, there's always a possibility people could get confident, right? So if we were to fall off this side, our broker would come to us and want us to give not only that 31 cents back, but because this is a dollar spread, they'll want us to give the remainder of that dollar out of our pocket. So what our broker does is our broker takes 69 cents. That's the difference between 31 and a dollar. And they kind of lock it up. It's called the margin requirement. So if you think about it, they give me this 31 cents, right, of cash, but they kind of put that 31 cents and that 69 cents on kind of a hold. They make sure that we've got that amount in our portfolio so that either we close the trade or March 18 rolls around and they make sure that we're not going to ever need that the trade didn't fall off the back end. But so if you think about it, this trade actually cost me virtually 69 cents to do. But okay, so it cost us 69 cents. We took a few pennies, we took a little bit of that 31 cents and we bought the 14-cent debit spread. What's nice is if the trade is on this upper half, we get the other half of that 14 cents. So we get, in this case, 86 cents. We get to keep the 31 cents and we get 86 cents. Now, that's almost a 200% ROI if you think of the initial 69 cents I have off the shelf. So if it just wound up staying in the middle zone, well, then I'd get to keep, what's the difference between 31 and 14? Something like 16, 17 cents. I keep 17 cents a share. So like I said, break even, a slight credit, enough to cover commissions for all these trades. But if I jump up here, well, now we're talking about um, 86 cents plus 31 cents per share. So 86, 87 plus 30, 97, a dollar 7, a dollar 17. So you're getting a dollar 17 a share when you jump up here. I mean, now that's a payoff, seeing as how over here it was going to be something like 17 cents, right? 17 cents versus a dollar 17. I mean, come on, that's awesome.